All right. Welcome back, everyone. Ready to unlock some serious investing knowledge?
Always ready. Let's do it.
Today, we're diving deep into the world of investing formulas. I know what you might be thinking.
Formulas, huh?
Yeah, they might sound a little intimidating, like something you'd find in a dusty old textbook.
Right.
But they're actually super powerful tools.
They really are.
They give us a framework to understand how investments work.
Exactly. A way to decode the financial world.
So we've got this awesome list of the top 50 investing formulas.
Okay. Sounds good.
We're going to break down a bunch of them.
All right.
Not just what they mean,
Right.
but how you can actually use them to make smarter investment decisions.
Love that. Practical application.
Exactly. And trust me, this is going to be way more interesting than just memorizing equations.
Yeah. I think a lot of people get turned off by the math.
Yeah.
But it's really about understanding the concepts behind them.
Exactly. It's about getting that aha moment.
Right. Seeing the story behind the numbers.
Totally. Okay, let's jump right in. One formula that caught my eye is the compound annual growth rate. CAGR.
Ah, the magic of compounding.
Right. It sounds kind of complicated.
Yeah.
But it's basically like the snowball effect for your money.
It is. It's how your investments grow, not just on your initial contribution,
Okay.
but on the gains you've already made.
Ooh, interesting.
So think about it like this.
Yeah.
You invest $1,000, and it earns, let's say, a 7% return in the first year. So you end up with $1,070.
Okay.
But the next year, you earn 7% on that $1,070, not just the original $1,000. That's compounding in action.
So the higher the CGR, the faster my money is growing, right?
Exactly.
Yeah.
TGR is all about growth over time.
But I've also heard, like, chasing super high KGR can be kind of risky.
Yeah.
Is there a downside to just focusing on that number?
That's a really good point,
Yeah.
because you always have to consider risk
Right.
alongside the potential reward.
Okay.
A higher CGR usually means faster growth, but it often comes with higher volatility too.
Oh, volatility. Got it.
Yeah, so imagine two investments over, say, 10 years.
Okay.
One has a nice, steady 6% CAGR.
Okay. Nice and steady.
The other one has a wild ride, averaging 10% CAGR,
Whoa.
but with some big swings up and down.
Oh, so it's not always about the highest number.
Exactly, because the steadier investment, the one with the 6% CAGR, might actually end up with a higher value.
Oh, because it didn't suffer those big drops during the downswing.
Precisely. Sometimes slow and steady wins the race.
It's like the tortoise and the hare, right?
Exactly.
So speaking of figuring out which investment might be the tortoise, we've got another formula here, the price-to-earnings ratio, or PE ratio for short.
Yeah, PE ratio, a classic.
It seems like everybody talks about the PE ratio.
It's a really useful one. It helps us understand how much we're paying for each dollar of a company's earnings.
Ooh, that makes sense.
It basically gives you a sense of whether a company's stock price is, in line with how much profit they're actually making.
So a high PE ratio, like 30 or 40,
Yeah.
would that mean like investors are really optimistic about the company's future?
Yeah, that's one way to interpret it.
Okay.
A high PE ratio could mean investors believe the company has huge growth potential.
Right, they're betting on it.
Exactly. And they're willing to pay a premium for its stock.
But I guess you have to look at it in context.
So absolutely. Context is everything.
Like a tech company versus something more like traditional.
Exactly. If a company is in a fast-growing industry, like tech or healthcare,
Yeah.
a high PE ratio might be totally normal.
Right.
But if it's in a more mature industry, one with slower growth,
Right.
then that same high PE ratio, that could be a red flag.
Ooh, a warning sign?
Yeah, like maybe the company is overvalued.
Okay, that's making me think about my own portfolio now. I've definitely got some companies with higher PE ratios than others. How can I, practically apply this when I'm making investment decisions?
Well, a good starting point is to compare a company's PE ratio to its peers in the same industry.
Ooh, Apple to Microsoft, that kind of thing?
Exactly. See if it's significantly higher or lower.
Okay.
And if it is, try to understand why. Are they a disruptor? Do they have innovative products?
Right, they could be the next big thing.
Exactly. Or are they struggling to keep up with the competition?
Ooh, that's a good point. So the PE ratio is more like a starting point for research.
It is. It's like a clue that leads you to dig deeper.
It's like a detective novel.
Yeah.
Okay, let's shift gears a bit. Another formula that caught my eye was dividend yield.
Ah, dividends. A favorite for income-focused investors.
Right. This one seems to be all about how much cash an investment is putting back in my pocket.
Exactly. Dividend yield tells you how much dividend income you can expect for every dollar you invest.
Ooh. So like a percentage.
Exactly. Let's say a company has a $2 annual dividend per share and a stock price of $50.
Okay, I'm following.
That would give them a dividend yield of 4%.
Okay. So is a higher dividend yield always better? More cash is good, right?
Well, you'd think so, but it's a little more nuanced than that.
Oh, okay. There's always a catch.
While a higher yield might look tempting, you got to consider the company's overall financial health.
Makes sense.
Like, why is their yield so high?
Yeah. What's the story there?
Sometimes a struggling company might offer a really high dividend yield just to attract investors.
Oh. So it can be misleading.
Exactly. So always check if they have a solid track record of paying dividends, and if their future prospects look good.
Got it. You got to do your research.
Always a good idea.
This deep dive has been awesome. It's really shown me how these formulas are like tools to help us analyze and understand investments.
Absolutely. They give us a framework to think critically about our decisions.
And it's not just about memorizing a bunch of numbers.
Right. It's about seeing the bigger picture.
Exactly. Understanding the why behind the numbers.
And remember, the best investment strategy is the one that matches your goals and risk tolerance.
So well said. This has been a super insightful deep dive into some key investing formulas.
We hope you feel more confident about navigating the world of finance now.
Yes. You don't have to be intimidated by these formulas.
Use them to your advantage. And here's a question to consider.
Okay. Hit us with it.
Think about your own investment goals. What are you aiming for? Growth, value, income.
Ooh, good question.
And then consider how these formulas can help you evaluate different investment opportunities.
That's a great takeaway. All right, everyone. That's it for today's deep dive.
We'll catch you next time with more fascinating financial concepts.
Until then, happy investing.
Happy investing.